Okay, great. Thank you for joining today to talk about taxes, one of my favorite topics. I am Treacy Riiska CPA. I've been practicing for over 30 years. Started at Deloitte, went to a medium-sized firm in Stamford for 20 years, and then went to work with the sole proprietor, Alex Linetti in Stamford, where I launched my practice 3 years ago. Today, we're going to talk about taxes. Let's face it, taxes can be complicated. As taxpayers, we are expected to comply with the ever-changing tax laws. The key is to minimize your taxes within the current tax code. No one likes paying taxes, and most people dread having to do them and gathering their information. Sure, you can have a CPA handle them, but it's really important for you to understand your tax return, at least to identify key terms and to be able to help you and your household and your business reach their financial goals. Yesterday, I was telling a colleague that I was doing this talk. Your tax return tells a story, your story, and without missing a beat, he said, yeah, a fictional story. I covered my ears and said, oh, blah, 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 blah. That's not what we're talking about today. Today, we want to talk about, are you keeping your financial house in order? And how is this tied to your tax return? It's almost the end of the year. It's a great time to, when you're gathering your tax information, to also think about where you are financially. We're going to get into that a little bit more. My advice is to prepare a financial statement, a personal financial statement for your household, at least annually. Filing your tax return is an annual requirement, so preparing a personal financial statement should be too. We're going to talk a little bit about that a little later. I did a presentation here at HAYVN in beginning of 2020, and it was to talk about, do you have the proper tax structure for your business? We could talk about that for a whole hour, but I want to touch on some important things so that you understand as business owners if you have the proper tax structure. And we're also going to talk about the 4 major components of the tax return, which to me are your total income, your adjusted gross income, taxable income, and tax liability. If you're a non-tax preparer, you're not going to understand everything that's on there, but at least to be able to identify those key components and a little summary about what makes up each of those items. Within the 4 components, total income, adjusted gross income, taxable income, and tax liability, there are 4 major factors we must consider, and that's the tax code is full of phase outs, thresholds, exceptions, and exemptions. So we can't get into all of that today, but I would like to just bring home some important points. So when you're gathering your information for this 2021 tax year and giving it to your tax preparer, that you'll hopefully will have taken away a few pieces of good information today. What is your tax return saying about you? Next slide, please. It gives you valuable insights, as we talked about, understanding your financial situation. And one of the important things to know is that most of life's major moments affect your tax situation. Whether you buy a new home, you sell your principal residence, you buy rental real estate, you start your family, you get an inheritance, you are retired and you're starting to take retirement distributions, you're saving for your financial future, you want to make retirement plan contributions. So that's why I say your tax return tells your story, because so many of life's moments affect your tax return. And especially, did you start a new business, which most of us here, that's where we're at, we're business owners. Communication is key between you and your tax preparer. You should ask questions. And your CPA most certainly should ask you questions so that they can understand your tax situation, because you don't know what you don't know, and the CPA isn't going to know without asking the right questions to identify where your possible tax strategies are going to be, or things that should be included on your tax return. And how organized are you? Are you up to date? Are you last minute? Are you, throughout the year you're keeping track of it? Those things are important, especially for keeping your financial house in order. like I said before, filing an annual tax return is an annual requirement. So let's make keeping our financial house in order also a requirement. We talked what I was saying about the personal financial statement. So when you're getting together your tax documents, take a few extra minutes and just calculate your net worth. And how do you get that? Most simply is looking at all of your assets, your cash, your investment accounts, your retirement plans. You can put your house on there. You know, there's differing opinions on how to really put that on a financial statement. Those are all the things that you own. Then you look at your liabilities, everything that you owe, your home mortgage, vehicle loans, if you have credit card debt, like all of those things that you owe. So assets, things you own, less liabilities, things that you owe, comes up with your net worth. Now you know where you're starting from. Make it a game, gamify it, challenge yourself to increase your net worth, either monthly, quarterly, annually. I think it's really important to have your starting number because let's face it, we're working so that we can retire, we can have financial freedom. So the only way we're going to get there is if we know where we are and where we're going. So that's how I feel like it ties into this conversation about taxes because it's the end of the year. Next slide, please. Our first major component, total income, types of income that are reported on the 1040. If you have wages and earned as an employee, those are going to be reported on a W-2. Most of us are business owners, sole proprietor business income, that's reported on a Schedule C within your 1040. If you have a partnership or an S corporation, the income passes through to you on a Schedule K1. And then that income is picked up on a Schedule E within your 1040. So most of us are probably Schedule Cs or S Corps, which are pretty popular right now. It also, your total income also includes your investment income, taxable and non-exempt. Investment income can include interest, dividends, capital gains. And I will say this total income, if you have a loss on your business, so your income could also be a loss. It could be reported as a loss. If you have capital losses, you're also going to show your losses. So even though it says total income, it's the combination of income and losses. If you have retirement plan distributions, if you're at that retirement age, the Secure Act changed the rate of required minimum distributions to 72. And also, due to the pandemic, there was a lot of hardship withdrawals. And they have had special rules where you could allocate that hardship distribution up to $100,000 and pay the tax over 3 years, or you could pay it back. So they did give some leeway in terms of not having to pick up all the income at one time, and certainly to help save that 10% excess tax penalty if you make an early withdrawal in your retirement plan. Social Security benefits would be another type of total income, rental real estate, and the catch-all other income. For an example, if you're on a board and you receive board fees. I would like to mention on your 1040, the IRS is now starting to think more about cryptocurrency. And there's a question, and it says, it's right under the address, your name and address, so right there on your 1040. At any time during the year, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency? So that's a really important topic to discuss because you would have to pay capital gains tax on cryptocurrency, Bitcoin, virtual currency. Next slide, please. This has to, this is what we're talking about if you have the proper tax structure for your business. I hear it all the time. I'm an LLC. Okay, but how is your business taxed? An LLC is basically a legal term saying that you're, as the owner, you are hopefully, and most times, excluded from personal liability of the company's debts and liabilities. So the LLC, that's great, you're an LLC, but my question is, what's your tax structure? A lot of clients are Schedule C clients. So you would pick up your business income, your gross income, less all your deductible expenses. It would be reported on Schedule C. Your Schedule C income is subject to self-employment tax, as if you are the employee and the employer. So it is a hefty tax for small businesses to have to then not only pay ordinary tax rates, but then have to pay The self-employment tax is if you're an employee or an employer. A partnership is if, if you have two or more individuals who have formed a partnership, that information, you have to have a separate business tax filing, Form 1065, and that's where partners would receive Schedule K-1s at the end of the year to show their proportion of income and expenses. And same thing for S corporations, you would receive a K-1. And LLCs can also be C corporations, but that's outside of the scope of today's talk. How do you know? When you registered your business to get your federal identification number, your EIN with the IRS, they will have sent you a letter, and on that says your business name, address, and it'll say how you're taxed. It'll say sole member, which means sole proprietorship, or it'll say partnership, S corporation, however you're taxed. Okay, so we talked about the Schedule C and the Schedule A. I think we're good here. If a quick tip that I've learned, because getting through to the IRS is very tricky right now, is to call at 7 a.m. Call 7 a.m. Tuesday through Thursday, and call at 7 a.m. so that you can get into their queue before it is filled up. So everyone's like, I can't reach the IRS. Call at 7 a.m. Next slide, please. There's many factors that determine what type of business you should be. S corps are trending right now under the existing tax code. That may change, but as of now, it's still a very beneficial tax structure. Up till now, I have converted a lot of to S corporations. Right now, we're kind of holding off to see what's coming down the pipe next year for any possible tax changes. What are the benefits of being an S corporation? You as the owner pay yourself a salary, reasonable compensation, which is not completely defined by the IRS. So it's reasonable compensation. And then you take all your other expenses, you come down to your bottom line, your net profit, that is not subject to self-employment tax. So it's a great vehicle. That may change. They're actually in the proposals, they're talking about having S corporation, bottom line, taxable income, subject to self-employment tax. For now, it's not. One of the other benefits is as you may know, on your itemized deductions, there's now a $10,000 cap. They call it a SALT cap, state and local taxes. That's your state taxes, your property taxes, your personal property taxes on your vehicles and such. It can't be over $10,000. That's the maximum deduction. So Connecticut and many other states help circumvent that by saying, okay, we're going to consider these S corps and partnerships as pass-through entities where the business is actually going to pay the state tax. And then the business gets the deduction versus not being able to take it as a deduction on your individual tax return. The business takes the deduction, and then a K-1 goes to the partner or the shareholder, and it shows a credit of the taxes that were paid on your behalf to the state of Connecticut, let's say. It's a great tool. What else? And then we can't forget qualified business income tax. That's probably coming up in the next couple slides, so we'll hold off talking about that, but you might hear of it as Section 199A, qualified business income deduction. That's scheduled to sunset at the end of 2025. Very valuable tool for deduction for small business owners. We'll get to that in a couple of slides. Next, please. Another part of your your tax return tells your story is investment income that's reported on your tax return. How much money is your money making? Ben Franklin said, money makes money, and the money that money makes more money. So let's make more money on our money. I mean, it makes sense to me. Again, investment income can be interest, dividends, capital gains and losses. And it will also, your tax return also shows if you have any tax exempt income. Perhaps you have municipal bonds. Thing to remember about that is if you live in the state of Connecticut, if you have Connecticut municipal bonds, those are exempt from federal tax as well as Connecticut tax. If the municipal bonds are out of state, you need to add that back to your Connecticut taxable income, and pay taxes on that. And the other thing to know about investment income is this net investment income tax. If your adjusted gross income, one of the major components of your tax return, if it's over $250,000, you have to also pay an additional 3.8% on that, say, capital gain. They're actually talking right now, the net investment income tax is on things like capital gains and passive income, which would be if you are a partner in a partnership, but you don't actively participate, you're passive. If you have income, that is subject to this 3.8% if you fall into that threshold. Another proposed change is that they're going to include this 3.8% on active trade or business. So not only Schedule C, not only are they paying ordinary tax on their taxable income and they're paying self-employment tax, they could possibly now have an additional 3.8%. That's in the fine print of the proposed changes. Okay, next slide, please. Other events that may trigger a taxable income, taxable event. We talked about some of them at the beginning because that's what tells your story, right? If you start a new business, you sell your personal residence, you buy rental real estate, you sell rental real estate, all those things are taxable events. Again, this is where it's key. Communication is absolutely key. I know with our clients, we send out a checklist. It's 7 or 8 pages, and you have to fill it out. And it's asking you all types of questions. I mean, I'm happy to talk on the phone anytime, but this has it, just in plain words so that you can follow along. You can send in, gather the right information, and we've asked a lot of questions to know your tax situation. It's crucial to have that communication with your tax advisor. Next slide, please. Our second component is adjusted gross income. You're going to take your total income that we just talked about, all those facets of it. You subtract from that your adjustments to income. We won't spend too much time on this, but the three most common adjustments to income are self-employed retirement plan contribution. Very important. You want to save money for your financial future. Take advantage of the retirement plans that are available. The Secure Act made some major changes, one of which being in the past, once the year was over, you could not set up a retirement plan for that year. The Secure Act changed that, where you have until the time your tax return is due, plus extensions, to set up a retirement plan for the prior year. Huge, it's huge. So really, you really that's unprecedented. So even if you haven't set one up for this year, you're sitting on some additional taxable income for your business, talk to your advisor about setting up a plan. Also self-employed, the second bullet point, self-employed health insurance deduction. That is, you're self-employed, you pay your own health insurance. Where do I deduct that? You can't deduct it on your Schedule C. You have to deduct it within this section, adjustments to income. If you don't have any taxable income, then you don't get the deduction. You have to show taxable income in order to take the health insurance deduction. And then the third point is you're taxed on your bottom line for self-employed taxes. Then you get half of it back in this adjustment, kind of even it out. But of course, you're paying a lot of self-employment taxes, but at least it helps out a little bit. Next slide, please. Yeah, that was, yep. Okay. So what did I want to say? Oh, to find those adjustments to gross income, look at for instance, your 2020 tax return, and you'll see if you have any amounts on Schedule 1, Part 2, those are your adjustments to income. And then we won't talk long about this, adjusted gross income, often called AGI. Total income less adjustments to income equals your adjusted gross income. Why is it so important? Because it's used for many of the thresholds, phase outs, exceptions, and exemptions. That's really the importance of adjusted gross income. Next slide. We're going to talk about your taxable income, which is the third component. And maybe we should take a deep breath. How is it so far? Everybody, I'm sure everybody's following along. Please let me know if you have any questions in the chat or with us live here. Your taxable income equals your adjusted gross income, less your standard deduction or itemized deductions, and less this qualified business income deduction that we briefly touched on. Under the Tax Cuts and Jobs Act, the standard deduction was almost doubled. Before, a lot of people qualified for taking itemized deductions, your medical expenses, if they're major medical expenses, because there's AGI thresholds for that. We have our state and local taxes that we talked about. That was most of the reason why people could itemize. Now it's capped at $10,000. So it's $10,000. Your home mortgage interest, another line on your itemized deductions. Charitable contributions, both cash and non-cash. Those are the main components of itemized deductions. The one that they got rid of a few years ago is that miscellaneous business expense, which really helped employees who their income is reported on a W-2. They were able to take a portion of those unreimbursed business expenses that no longer exists. Hopefully they'll bring that back one day. So between the standard deduction going up and the cap on the state and local taxes, a lot of people don't itemize anymore. The people who do are usually people who have significant charitable contributions. So another thing, how it tells your story is if you're looking at your home mortgage interest and it's really high, that means you need to think about refinancing or paying it down faster. It tells you how much debt you have. So that's another kind of valuable tool by looking at your tax return. And with the SALT tax, remember, I'm just going to refocus on it, is that if you're an S corporation or a partnership, it is now a pass-through entity where the business pays the state taxes. It's deductible, and then you get the credit on your individual tax return. Definitely a solid tax planning strategy. And next slide, please. We're going to quickly talk about this qualified business income deduction. It's basically a 20% deduction looking at qualified business income, which again, all types of calculations. When you come down to the qualified business income, it's 20%. If you're a trade or business, then there aren't too many thresholds that apply. If you are a specialized skill, for instance, accounting, law, health, consulting, bunch of different specialized skill where you developed a skill that is part of your business. So that's a specialized skill. Real estate agents are not in that category, nor are architects. Those are treated as trade or business. If you remember one thing today, then go back and look at your tax return. Look at that line. It's on your Form 1040, line 13, to see if there's an amount on that line. If not, talk to your tax advisor. There definitely could be thresholds and exemptions of why you're not getting it, but it's a really good conversation to have with your CPA. Next slide, please. Your taxable income. This is your third major component, and this is what is used to determine the tax bracket that you're in, depending on your filing status. If you're single, married, filing jointly, head of household, widowed, married, filing separately, all those different types of filing statuses. Again, there's lots of deductions and credits that are based on taxable income. So adjusted gross income and taxable income, those are two of the major components where the tax code comes in, and they look at those two numbers to determine if you qualify for certain deductions or certain credits. And then once you have your taxable income, you look at the tax bracket, you calculate your tax liability. And this provides more valuable information, and certainly a reason to pay attention to your tax planning. If you're a Schedule C, as you know, you have to pay in quarterly estimated tax payments so that at the end of the year, your tax liability isn't, sky high, too much to pay at one time. So it's really important to look at it quarterly to determine if you've paid in enough money. And from your tax liability, that you've looked at your taxable income, you've looked at the tax brackets, now you know what your tax liability is. Now you look at what you've paid in for your estimated tax payments, or what you're withholding on your W-2 if you're an employee, and any of your estimated tax payments. So you add up those things, you come up with what you've paid in, your tax liability, less what you've paid in by either withholding or estimated tax payments. That's how much tax you owe, or how much refund you have. You never want to have a large refund, because that just means that, you know, your money isn't making money. And if you owe a lot, then you need to do a better job in tax planning so that you don't have that big tax consequence at the end of the year. You'd rather pay it in throughout the year than all at one time. Okay, then it's all about keeping your financial house in order. I think that, what I wanted to say about the brackets, I'm just gonna go back for a second. There weren't any major changes in 2021. It really came down to the wire as to whether or not the highest tax bracket would change back up to 39.6. It is staying at 37% for 2021. Some of the proposed changes that will be coming down the line, perhaps, they're talking about a surcharge on if your income is, they call it modified adjusted gross income. If it's over $10 million, you would then, on top of these rates, would have to pay another 5%, and plus the 3.8% in net investment income tax that could be changing to include active trader business. So lots to watch out for on the horizon for proposed tax changes. I know in our office, we're always paying attention to what's coming down the pike. Keep your financial house in order. Keep an eye on your financial picture, whether it's monthly, quarterly, annually, but make a commitment to yourself and your financial future to know exactly where you are. Staying financially organized will make tax time much easier in gathering your information. You won't be scrambling at the last minute, and you will understand where you are and where your business is. Your CPA can't do much after the tax year. So it's important to have that communication throughout the year. Hey, my business made this much more money, or I'm losing money. Like, what can we do to help strategize to figure out a good plan for you? After the tax year is over, there's really not much that can happen. Next slide, please. Tax returns, financial statements, it's all part of keeping on track with your financial goals. Reading your tax return and preparing your financial statement are great tools that can help you reach your goals. You can't manage what you can't measure. That's why I say it's important to know what your net worth is. The number's there, whether you know it or not. So why not know it? Know where you are, know where you want to go, and fill in the gap to get there. I think it's important to, as we're in the holiday season, always live in a state of gratitude for where we are, what we have, and where we're going. Next slide, please. As I said, you're finding out your net worth. It's your starting point. Where do you want to be in a month, a year, 5 years from now? Know where your money is going. Write down your financial goals, break them down, list the action steps that are going to get to you, develop the habit of taking action, and acknowledge your progress, and communicate with your tax advisor. They want you to be successful as well. Next slide. Now is the perfect time for tax planning. We're the beginning of December. Go home, get all your stuff in order so that you're ready for the end of the year. Reach your financial goals. We are happy to help. If you would like a copy of our 2021 year-end, last-minute year-end tax strategies, please email us at info@Treacy, Treacy CPA.com. And we're happy to send that off to you. Happy to have a quick consult with you and help in any way that we can. And that is me. This is our contact information. So please drop a line, give a call, and hopefully sending you away with a few nuggets as we wrap up the year. Thank you.
So I'll stop sharing and questions. I don't have any in the chat. Anyone here has any questions?
Just a quick question. You sent me the form that they send you the tax ID number.
Yes.
It says the tax structure. Can you change that?
Can you change the tax structure?
Right.
Yes, you can. You can, if you're a Schedule C sole proprietor, you can convert to an S corporation. You would then have to obtain another employer identification number. And you would also have, that's a great question. You'd also have to file a form 2553 if you wanted to convert to an S corporation. And that only can be done within the first 75 days of the tax year. So it'd be too late for 2021, but for 2022, for good solid tax planning, if it makes sense for you to convert to an S corporation, you'd want to do that within the first 75
Does
days.
it make sense to change to an S corporation?
It really depends on your individual situation. A lot of times, yes, for now, because we don't know what's
Right.
coming down the pike, but the qualified business income deduction, that is scheduled to sunset at the end of 2025. If we have major tax reform, we don't know if that'll survive a new tax reform, but for now, that sticks. So S corporations are a really good vehicle.
Good question. For the AGIs, it says the standard deduction and itemized deduction, or
Right, standard, or, yep.
And is there
correct.
anything else? What else is subtracted from the AGI?
The self-employed health insurance and your, I don't know, for some reason I'm just having a moment, I forget the three that I had there. I tried to put the most important ones.
The retirement, I wrote it
Retirement.
down, yeah,
Yeah.
self-employment retirement plan contribution.
Yeah, exactly.
Health insurance reduction and
Thank
half
you.
of the
Yeah,
tax
yeah.
reduction.
Which the retirement plan contributions could be very significant. There's different types of vehicles that could be used outside of the scope of today, but happy to host another event to talk about the different types that are available to small business owners and the availability that the Secure Act has made them available even after the year ends, which is huge.
How do you think, more of a general question, how do you think the, all of the unemployment benefits that people were receiving during 2020 would affect the tax filing for 2021?
That's a good question. I have to look to see if they extended, because in 2020, they allowed, was it 12,400 or something to be extended? I'm not sure they extended that to 2021. I'd have to follow up with you with that.
Okay.
I'm not sure. I should know, but I don't know right now.
Just in terms of like, if we were, like, for example, I was receiving unemployment
Mhm.
benefits in 2020, and yes, we included that as an income because it was
Yes,
an income.
correct.
But like, if any of that amount would have an effect on this. on
Not the
2021.
2020, if you received some in 2021, it
Then
would.
you would.
It would
But
be
otherwise-
included
oh,
as
okay.
income.
Okay.
I just don't know if they extended that exclusion, the 12,000
Okay.
exclusion to 2021.
Yeah.
And also, again, beyond the scope, childcare credits have gotten huge. A lot of change has been made on those.
Mhm.
The amounts have gone way up for childcare credits, so keep an eye out for that too. Great question, thank you.
If there are no other questions, I kind of had more of a general kind of, if you had any tips for businesses that have just started on what would be sort of like good financial planning practices that small businesses should take, other than looking at their returns and, timely.
Right, look,
Taking-
I mean, it would be keeping your books and records up to date and looking at your revenue and your expense line items. And have that as a gauge as you go forward to determine the variances of what's happening, if they're going up or down. If you, in terms of tax year end, if you have too much income, perhaps you could stop billing for December and bill in January, so you wouldn't have to pick up that income. If you need more expenses, if you're a cash basis taxpayer, if you make a credit card charge, that's still in 2021, that would still be an expense, even though you haven't paid for it until the following month, that would still be a deduction for the current year. If I think of anything else, I'm sure there's tons of things to say,
Yeah.
but. yeah.
All right, thank you.
Mhm.
Great, so I think that's
Great.
it. We don't have any more questions. Well, thank you so much, Tracy. It's always
Thank
great to have
you.
you. Thank
Thank
you
you.
everyone for joining.
Yes, thank you all for coming.
Okay,